Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 22nd of February. I'm Daniel Lam, your host for the podcast. Lately, Chinese equities have been doing pretty well. The Hang Seng Index reopened after the Chinese New Year holidays, right after the hawkish US CPI print. Now, the index flirted with the key support level at 15,400 and closed at the day high. Since then, the Hang Seng Index gained more than 1,000 index points. It broke above critical resistance at 16,453 and also the first downward channel on the chart. So are we finally in for better times for Chinese equities? Well, there have been attempts by the policymakers to prop up the stock market. For example, domestically, a new regulation stipulates that major institutional investors are no longer allowed to sell more shares than they buy at the open or close of the trading day. Authorities have also increased the scrutiny on quant trading after announcing a 3-day ban on one of the largest domestic quant hedge funds. Now, on the macro front, Chinese policymakers surprised on Tuesday with a larger than expected cut on the 5-year loan prime rate, i.e. the LPR, which is the benchmark for most of the mortgages. Now, this LPR was reduced by 0.25% to 3.95%, and that's versus an expectation of a reduction of 0.1%. And this marks the biggest cut since the reference rate was first introduced in 2019. So this is the latest in a series of efforts to revive the property sector and private sector sentiment, and will likely be followed by further easing ahead. So what do all these mean to investors? Well, it is essentially putting a floor to Chinese equities. So for example, looking at the Hang Seng Index chart, that 15,400 seems to be a double bottom support. But as we've been highlighting in previous podcasts, there needs to be real improvement in the economy in order to sustain the market rally. Because deflationary headwinds continue to be affecting the China economy. Producer and consumer prices are declining, house prices are falling, and home buyer sentiment remains depressed. And of course, the real rates are still relatively elevated, despite the drop in the nominal rates. So ultimately, broad-based deflationary pressures are still likely to be overwhelming the impact of policy easing on the aggregate economy as of this moment. This needs to be observed. So we continue to believe that US and Japan equities, as we spoke about in the podcast this week, they remain our regions of choice and overweight in equity markets. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.